Yield curve has inverted, or there is an inversion in the yield curve. Haven't you heard this phrase a lot in the last 6 months at least, or in the recent times, as recent as yesterday as well? Now, it's not as complicated as it actually sounds. Before I explain you what is an inverted yield curve, let me tell you what is a yield curve. A yield curve is a graphical representation of the interest rates that one will actually receive when the bonds mature across different maturities. The yield curve slope normally is an upward facing slope. It's an upward going slope that is reflecting that the holders of the long term debt have taken on more risk than that of a short term holder. So that means the long term bond holder will be paid more than a short term bond holder in terms of the interest. The most closely watched out yield curve is that of the US Treasury debt. Now, since you have understood what is a yield curve, let's talk about what is an inverted yield curve. And what does it actually mean? Inverted means flipped, and so when the yield curve is inverted, that time the short-term bond yield will be higher than that of the long-term bond yield. Normally, investors are rewarded with a higher interest rate for holding the bonds for a longer period of time, resulting in an upward sloping yield curve. So normally it's an upward sloping yield curve. Now this is because that these longer returns factor in the risk of inflation or even defaults over a period of time. Now, wondering why is everyone actually worried when the yield curve is inverted? Why is it a bit of a worry? Because historically, inverted yield curve has been a worrying trend and precautious trend to a sign, to a precursor to a recession as well. Now, it is generally regarded as a warning sign for the economy and the markets as well. It is seen that in the past, a recession comes after a year or so of the conversion of the yield curve. Inversion is uncommonly and reflects the bonds investors is expected for decline in longer in term interest rates and typically associated with recession. At the end of 2022, let me talk about that. Given the unprecedented inflation that we have seen coming in, the yield curve got inverted again. And as the gap between the 10-year yield and the 2-year treasury yield of US was larger and widest gap in almost 2 decades that we saw coming in as well. Just yesterday, what we saw is in India that the yield curve also got inverted in terms of the 1-year yield curve and the 10-year yield curve. There was an inversion between those as well. So yes, in India also we have seen that yield curve happening, and that was for a brief moment of time, but that's a big factor that one should be keeping an eye out on. Now, that is one has to watch out for that, will this be indicating a trend of a recession? Will we be repeating history, or will this be a different story this time, is what we are watching out for. So that is what all it is about in terms of yield curve and yield curve inversion.
If you like this video, then like, share and subscribe to ET Now.